Tsachy Mishal of TAM Capital Management. At a 17% free cash flow yield, how can any acquisition stand up to that test? It's a business that you know, and you could get a 17% after-tax return. Why not put even more money into the share repurchase?
Yeah.
And secondly, while I believe a share repurchase is better, you can still commit to shareholders by saying we'll return $5 billion over the next 3 years. It doesn't necessarily have to be a dividend, but why not a commitment versus just saying we're repurchasing aggressively, which could stop tomorrow?
Well, so let me address a few themes there. First of all, I do think it is important to continue to have a balance between the use of capital in terms of returning it back to shareholders and using it on acquisitions that will allow us to accelerate our strategy, get time to market faster, and that will drive additional cash flow generation streams out into time. Again, we've got good opportunities. We're right in the middle of very good markets, but they're evolving relatively quickly. And it's important that we make the right moves in terms of M&A in a disciplined way, sensible prices, real focus on integration. And so we'll continue to have that type of perspective, and I think that will be important to driving those top-line type projections that I offered that will drive the sort of cash flow generation, that will drive the present value, that will drive stockholder value. Now, in terms of the buyback volume and so forth, last year we used an amount basically equal to the generation of our U.S., of our onshore cash flow from operations. We deployed an amount equivalent to bring down our share count net 4.3%. That's a strong record, I would argue, by any measure. And further, I would argue that while I accept your notion that it can be turned off, I think you have to look at the history. For the last 6 years that I've stood on this stage, we have consistently bought back a large volume of shares every year through some of the most difficult macroeconomic climates that the country has faced in decades. And so I think we have built a consistent record that is illustrative of the seriousness of intent that we have in terms of returning shareholder value.
Could I just follow up? In the past decade, you've spent $20 billion on acquisitions. The enterprise value is $9.5 billion. It's not working. Why do you think that that's suddenly going to change?
Because we have strong market opportunities in front of us. We're very focused around the value that we put into acquisitions, and we're very focused on integrating to get the value out of those acquisitions. We back that up by reporting to you on what we expect each quarter coming from an acquisition. So you can very much hold us to account, if you will, in terms of our integration performance.